everybody. Welcome to the morning market briefing, Friday, October 14th, 2022. Hope you're doing well out there. Hope the week has been good. We've got Ben and Tom joining us remotely. I believe they're still in Austin. Guys, how's Texas?
Good morning.
It's great.
It's very nice out right now. It's been exceptionally hot. It's like 100 degrees here, but it's very nice out at the moment.
Nice. How's the conference been?
It was actually very useful. I was very impressed with the quality of the content and how quickly they came in and came out. It was just like 35, 40-minute quick hitters. Here's some ideas. Here's what we're thinking at a pretty good level. I learned a lot. In fact, I learned a lot more than a lot of conferences, and especially in terms of amount of knowledge per unit of time. I thought there was a bunch of good material.
Yeah, I would definitely agree with Ben. There was some really interesting data presented, particularly as it relates to what the Fed's doing and how the Fed operates. I'm sure we'll get into this a bunch on calls coming forward, but we learned a lot about how the M2 money supply works, which is something you kind of learn in high school when they talk about economics. And I thought I had a pretty good idea of how it worked. And then this guy, Brian Westbury, who spoke yesterday, completely blew my mind as to how the Fed works. So I'm very much rethinking my whole life right now. So that's where we're at. It's been a weird week.
Nice. So it sounds like the theme seems to be that when we go to conferences that none of us speak at, it tends to be pretty good. Oh, Tom's got a little bird action going on.
Yeah, this guy just got a big time flyby by this crow. Came right by me. So always a good sign when a crow lands next to you in the morning. Yeah. You know,
yeah.
Never marked for death at that point.
Had some good barbecue out there. Yeah.
Oh yeah, we hit Franklin's, which was awesome. It hurt both of us big time. We waited in line for like an hour and a half. And we got in the Mecca brisket. It was a lot more low key than I thought it would be. This bird is all over me right now. Nope. Yeah, this is so weird. But yeah, it was really good. But I'll tell you what, it definitely hurt us for the next couple of days. The amount of food we ate after that was very low.
Yeah, I've been there, had that exact same scenario. Well, let's jump into some market stuff. Kroger is confirming that they're making the offer for Albertsons. I think the biggest question is really, will this get approved? And then you wonder about just the timing of this, Ben, as it relates to where the cycle is and the period in which Kroger's had and grocery stores in general where they've really benefited. What are your high-level thoughts?
Yeah, I was hoping that this would be more of a kind of a merger of equals kind of a deal, but it's a very odd transaction. What they're doing is there's going to be a cash consideration portion where Kroger is essentially buying Albertsons, and then there will be a subsequent spinoff of a small chunk of Albertsons between 100 and 300 stores, which is odd. Why would you merge with a company and then just spin something off? And then there's going to be a special dividend for the Albertsons shareholders as well. So, there's not a lot that really adds up as a strategic imperative here. And my view is that the company just wants to get larger, which is probably not exactly what you want to do, especially when you're spending cash at this point in the cycle. Even if you're a staples company or grocery chain like Kroger is, you probably don't want to be spending large amounts of cash as we head toward a recession. So I struggle to see the strategic rationale here. Jason Sieb, our analyst, will have a lot more to say about it. He's done a lot more work on Kroger than I have. But for me, from a high level, the strategic move does not make a whole lot of sense.
Yeah, I wonder about it too. I mean, the timing, I think you're right, not only on the cycle, but even just the economic period we're in. I mean, it's questionable at best. I don't know. Maybe Kroger just feels like, hey, we've had a good run and this is the time to do some consolidating, but I don't know that it's the strategic move that I would have made. We're starting to get earnings entering earnings season in earnest. Ben, we heard from a couple banks. I know you hadn't had full access to all your equipment, but as you're kind of digesting, and we'll get back to the day yesterday, which was a pretty wild one in the markets, but as you're kind of digesting where we are, what are the major takeaways from the banks as it relates to where the economy is positioned?
Pretty much what we've been saying for the last number of months. Oh.
Unmuted the wrong thing. Pretty much what we've been saying for the last number of months, and that things have really picked up in the last couple of months between August and September. Things started to improve. We saw that in the retail sales data actually this morning. Retail sales accelerated, corresponding to what we've seen in credit card data and corresponding to what we've seen in inflation. In the normalized group, excluding autos and gas, what you saw was the revision for last month go from 0.3 to 0.6%, and you had another 0.3% on top of a 0.2 estimate this month. So good numbers on the retail sales. We're similarly seeing good numbers on the banks. Credit quality is actually remaining fairly robust, and so we're impressed by that. That's good. JP Morgan, his stock is up a little bit this morning. He does note that Jamie Dimon does note that there are some significant headwinds right now, especially with respect to inflation. He says in the US, consumers continue to spend with solid balance sheets, job openings are plentiful, and businesses remain healthy. However, there are significant headwinds immediately in front of us, including stubbornly high inflation, higher global interest rates, and the uncertain impacts of quantitative tightening, and it goes on and on, including the war in Ukraine, et cetera, et cetera. So there's a lot going on here. The fixed income trading piece was quite good across the board. For JP Morgan, fixed income trading was up 22%. Equity trading was down 11%, but the typical investment banks and trading operations is actually performing fairly well. Which should be a good read for Goldman Sachs. Interestingly, Citigroup and Wells Fargo are the underwriters and the deal makers on the Kroger Albertsons deal. So that was a good win for them. But you could also say that having Citi and Wells Fargo on your deal is not a great endorsement for the deal itself.
Explains a lot. kind of explains questionable deal. Who should we get to underwrite it? Let's get Citi and Wells Fargo. Kind of line there. United Health also reported earnings, pretty strong earnings. Stock was up about 1.5% earlier. It's fallen a little bit, but pretty strong growth there. They're continuing to see. They saw revenue grow at a significantly higher rate than costs, and that's really kind of the theme for any company. But when you wonder about the impact of inflation and expenses and things like that, you tend to think of healthcare maybe as somewhat insulated, but there's so much nuance to it that you kind of wonder how they're going to hold up. But
and you ain't seen nothing yet from UNH either. I think the rates are going to be phenomenal next year. You're going to have things go up in a big way. Already, we're seeing insurance costs go up 28% according to CPI data, and I expect that UNH is really leaning heavily on COVID and a number of other reopening factors to push through rate increases going into next year. So it's good for them, not so great for the American consumer or the American business.
Yeah, I would agree, and potentially create some stress for the hospitals themselves. So something to kind of keep an eye on. Wild day in the market yesterday. During the call, the market fell from up about 1% to down close to 2% in pre-market trading. We were down 2.5% before a really rapid, quick rally. I know you guys were kind of tied up with the conference, but Ben, Tom, what did you guys see from the CPI report that really stood out? I know y'all were sending me notes during the call. It was just I needed a third monitor in there. But what did you guys see that stood out, and what really precipitated that huge rally?
Yeah, I'll
for me,
first.
Sorry,
go ahead, Tom. Go ahead.
I was going to say, we're not seeing a lot of impact from what the Fed's doing, in my opinion. We're continuing to see the core tick up. We're just not seeing the effects of the rate hikes. My worry is that they're coming through, but it's all going to hit at once further in the future and cause quite a bit of calamitous economic ramifications. But I think that, in terms of what the bond market did, we sold off immediately. We saw a very sharp jump across the board, across the yield curve. And all of that kind of walked back throughout the day. So I think people are starting to get a little less insulated, or a little more insulated from the Fed hikes. And an excellent point was made yesterday by this guy, Bill Housey, who I followed for a while. He's a fixed income trader. And he was basically saying that the move from, essentially zero to where we are now is disastrous, but each subsequent move is going to be less and less so. And that's based on bond math, based on the concept of what's called convexity. And so the more rates hikes we get, the less impact there's going to be on the bond market in terms of capital losses, and the severity is going to continue to be less and less. So that's positive, and I think that's a great way to look at it. So there's going to be a lot of short-term volatility, but I think that like the most of the bloodbath has gone from the bond market, and the severity is going to be less because you just can't go from 0 to 4 and have the same kind of carnage going from 4 to 5 or 4 to 6. And so it's a good opportunity, I think, to start really feathering into some of these fixed income pieces and get into a position where, you're making equity returns on bonds, and waiting for the equity market to sort itself out.
Yeah, I think I met with a client yesterday. I mean, I think it's even a time if you have excess cash. It's a little bit counterintuitive, but I would feel pretty comfortable moving into the bonds or even moving into treasuries as one, an income generating vehicle, but also something that can hedge against additional volatility in the market. If you're sitting in cash and inflation remains the headline, you're not really generating value there. But if you can get something that gets you some kind of return and can offset potential volatility in the equities, I think that's a good use at this point. I don't know that was necessarily the case even 3 months ago, but we have, kind of to your point, Tom, we've seen some stabilization, even as measured by, bond index returns. We've kind of flatlined here for a while.
You can get 4.5% risk-free right now, which is pretty remarkable.
The 2-year treasury popped bigly yesterday.
And I think even when Tom was saying you see less of a degradation in price when you go from 0 to 4 when you go from 4 to 6. You see less of a degradation in price when you go from 4 to 8 than when you went from 0 to 4. And that's the bond math that he talked about. So, and on top of that, you're also getting income coming in. So you're able to offset a lot more of those losses than when you're getting 0.5% on those bonds. So you can
increase your more velocity as well. So you can get bonds coming back every 4 or 5 weeks, paying an annualized return of 4%. Suddenly you can get little wins where you can't get that necessarily in equities. And so I think that's something we need to start really working into.
And it's good agility too. Because the reality, I was talking with a client yesterday, when we stop seeing attractive opportunities kind of on those hyper short-term treasury plays, building out a 3-month, 6-month treasury ladder, when you stop seeing those opportunities, it's probably because the rate environment has changed. And when that's changed, it's probably a little bit of a different environment for equity. So if you want to rotate out and get back into a little more equity exposure, you're going to have a natural built-in structure to do so.
Couple more things on the CPI. I thought it was a very miserable number, just very depressing, because we had a lot of declines in some of those areas of the supply chain. So used cars were down 1.1, apparel was down 0.3% on a month-over-month basis. So multiply those things by 12. So lots of declines on those areas. There was declines in appliances, yet inflation accelerated, and the reasons were shelter was up another 0.7% on a month-over-month basis. Transportation services up 1.9%. And that's not your Uber, that's not your gas. That is your motor vehicle insurance, up 1.9% month-over-month. Medical care services up 1.1% month-over-month, accelerated to a cycle high. So, and that's being driven by health insurance costs. So a lot of the there's a lot of core, very, very, very sticky inflation that's built in right now that's going to take place over the next 12 months as well. And I think that makes the Fed's job unbelievably difficult right now. They're going to continue to hike like crazy. In fact, there's actually a 14% chance that the Fed does a quad rate hike, the biggest rate hike of the cycle, on November 1st when they meet. So there's actually a significant probability of that at this present time. So it makes it difficult to manage. However, the reason the market rallied yesterday was this was probably the last bad news we'll see for the next 3 weeks. So we're in this window of opportunity now when we're going to start getting news from companies, and these companies are going to be talking just like the banks, who came out today saying that credit quality is relatively good. Retail sales actually accelerated over the course of the quarter. The economy is actually in a good spot. And I wouldn't necessarily disagree. We certainly saw an acceleration in Q3 after a bit of a disappointing Q1 and Q2, but that only makes the Fed's job more imperative, and they're going to be on the brake with both feet now. And that is what is going to continue to create some market volatility. Ultimately, they view the transmission mechanism as financial markets, and so that is kind of ground zero for where they want to attack in order to slow inflation. There is a potential for a slower off ramp, but that's what the Fed's doing right now, and they don't seem creative enough to think about other solutions.
Man, it's janky doing three speakers. I don't know how we used to do this. No, I'm in agreement. I mean, I think we've got this little period where we're going to see relatively good data. Retail sales came in up 0.3% earlier this morning. Not a huge number, kind of in line with expectation, but it speaks to everything you just mentioned, Ben, where we have seen a bit of a reacceleration coming out of Q2, which was such a shock for people when the Fed finally got to action. We saw everything from hiring and wage growth, all of those things kind of stalled out for a little period, and things have kind of picked back up. So it's going to be a challenge for the Fed. We'll wrap it up there. We'll let you guys, I know you guys got to make it to Dallas next. Hope you guys have safe travels. We'll be back Monday. I'll be out, but they'll be back in the office. So we will talk to you guys. Hope you have a good weekend.